Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, March 26, 2010. We start with the big news of the day, which is that European leaders came together on a backstop aid package for Greece as pressure on the euro had been building without some kind of resolution. In the deal, each euro region country will provide non-subsidized loans to Greece based on its stake in the ECB. Europe will provide more than half the loans and the Washington-based IMF the rest. Those loans would only be triggered if Greece runs out of fundraising options. The size of the loans and interest rates were left unclear, but estimates are of the 20 billion euro range. The EU didn't spell out what would force it to step in. The statement said that the objective of this mechanism will not be to provide financing at average euro area interest rates, but to set incentives to return to market financing as soon as possible. The measure removes any default of risk, but adds uncertain elements as to when the loans would kick in. A lot will depend on how bond markets react when Greece moves to roll over its debt in the coming 2 months. During this crisis, the prices that financial markets want for Greek debt has been rising sharply as a result of the risk associated with the country, which has been making it difficult to finance its debt. Greek bonds did rise after the deal was brokered, with the 2-year yields heading for its biggest weekly drop since March 5th. So while Greece may find some relief in financing its debt with its backstop plan agreed to, it still will raise eyebrows in Washington and Beijing that the Eurozone needed help from the IMF to end this crisis. Therefore, investors and traders will begin to wonder what other structural problems there are within the Eurozone, as the Deputy Governor of the Bank of Japan said earlier this week that Greece may be just the tip of the iceberg. Taking a look at the euro-dollar pair, which had been pressured heavily midweek, especially on Wednesday when we pushed through the 1.3450 level, putting us to a new 10-month low in this pair. In today's trading, we did see the pair rally after testing support around 1.327. The pair moved above its 50-period moving average in the hourly time frame, and we rose above our resistance or our high from yesterday around 1.3360. So here we go. That was an important level, and we bounced up off of it after we tested it as support. So currently we are in the midst of some Fibonacci retracement levels of this swing we had throughout the week, as we tested resistance at 50%, which was 134, around the 134.20 level. So we'll see how this pair reacts coming out of the weekend, as traders and investors have more time to digest more details of the bailout plan. Our next level of resistance is this 1.3450 level, which we had broken through, which had been earlier acting as support, but we broke through. So it also coincides with around the 61.8% retracement of this move this week. If we zoom this pair out to a 4-hour time frame, we see our sideways trading that we were in throughout most of February and March, and up until we broke through our resistance, our support here at 134.50, as we had mentioned in this week's trading. We can set up a line of support connecting our lows during the middle of February, though we did slip a little bit below this trend line, but we could see that trend line now is acting as support again for this week's lows. Also, taking a look at the 2-week slide in the euro-dollar pair, we see that we've fallen from the 1.38 level down to 1.3270. So we have a pretty good way to rebound in case risk appetite swings more in favor of the euro. We have to see how markets digest the data, and our important test will come once the euro reaches this level here around 134.50 again. The pound-dollar pair had been sliding most of this week as well, as it moved from around the 1.50 level when we started this week's trading here to a low of 1.48 in the start of today's global session. Today we saw a bit of a counter rally to that down move as we tested 1.4923, but we still remain within a downward sloping channel in this pair. We now test near the 1.4950 level, this 1.4940 level, which had acted as support earlier in the week, but then we cracked through it, and now we're testing it as resistance. So how we come out next week will be an important indication for whether this pair will extend its down move that we had started back here on March 18th, or if perhaps we have a further retracement of this down move. Zooming this pair out to show a bit more price action, we see that we've also broken below this support that we had seen on March 10th. So this rally in the pound has completely reversed, and now we retest our supports from the last 2 months. In an interesting development, even as the dollar weakened against its European counterparts, the euro and the pound, it actually strengthened today against commodity currencies. Here we're taking a look at the Australian dollar, US dollar, and we see this rally that had begun on February 25th from 0.88 that moved all the way to 0.9250. We had resistance around 0.92 that we moved above shortly in the middle of March, but now we are retesting it as resistance, and since that retest we've seen this pair slide rather sharply. We could draw a line of support around 0.91 that had held here on March 14th and the 19th, but in this week's trading we cracked below that, showing a further consolidation, a further retracement to this up move. So it may seem that traders are liquidating some of their long Aussie dollar positions, perhaps in a bit of profit taking, as there wasn't really that much in the fundamentals that would show selling of the Aussie. If we zoom even further back to the beginning of February, we see that our rally in the Aussie is actually even higher, so a round of profit taking could make some sense. Now that we have moved to a new support, we could see that this had acted as resistance earlier on when we had consolidated in this rally in the middle of February and late February, and now we test that as support. So if we move below that, we could see even further retracement of this upswing. Taking a look at gold versus the US dollar during that same time period, we see that we had a rally in gold starting on around February 5th, and that reached a high around $1,145 on March 4th. So that helped the commodity currencies to gain, but since then gold prices have been easing, and in this week's trading we saw a move below the 1,100 area, showing some further weakness in gold. So even though we had a rally in today's session, that could explain some of the weakness that we've seen recently in the Australian dollar and in other pairs like the Canadian dollar. Now let's take a look at a couple of US fundamental releases. We had the final version of fourth quarter GDP come out, and it showed that the annualized rate was revised lower to 5.6% from our preliminary reading of 5.9%. That downward revision comes as we had a weaker non-residential fixed investment, private inventory investment, and personal consumption expenditures. The personal consumption dropping to 1.6% from 1.7% in the preliminary reading. In the second report, we had the UMISH consumer sentiment for the final version for the month of March, which showed a 73.6 reading. That was an improvement from the mid-month preliminary reading, which had 72.5 and is unchanged from what we had in February. Current conditions increased on the month, but they were countered by a decrease in the expectations index, which gave us this unchanged reading. As we can take a look on the right-hand side, we see that consumer confidence has stabilized the last 4 months in this level, and what we would need to see to continue this increase in confidence we had seen earlier is an improvement in the labor situation in the labor market. So if we have some positive non-farm payroll readings, which there's a good chance that could start with this month, we might see this reading increasing in the next few months. Coming up this week on Friday, we do have the non-farm payroll report and the unemployment rate. And earlier in the week, we will have data on personal spendings and incomes, on housing prices, the Conference Board Consumer Confidence Index, and 2 readings on the manufacturing sector, including Wednesday's factory orders and Thursday's ISM manufacturing PMI. The ISM manufacturing PMI and the non-farm payroll report, I would say, are the 2 most important fundamental releases to keep an eye on. However, on Friday we will have many banks around the world closed as countries in Europe and in Australia, New Zealand, and Canada celebrate Easter Friday. During the rest of the week, some key releases to look out for in the rest of the world would be UK data on housing prices on Tuesday and manufacturing PMI on Thursday. Tuesday will bring Australia's retail sales, and then Wednesday we get data on Canadian GDP growth and the Japanese quarterly Tenkan manufacturing survey. So that will do it for our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site, FXTimes.com. I want to thank you for watching and wish you a good weekend.